Oma Wilkie, Vice President at RSEG Group. Now, the offshore space since 2015 has been under siege, and perhaps 2018 was a bit of a ray of hope. But that notwithstanding, operators have pivoted away from their exploration or whale hunting type strategies and trying to combat the tougher times by looking for smaller to medium-sized discoveries in and around existing infrastructure. Now, through that lens, having access to or owning a platform can be viewed as an asset. And that's actually a large reason that operators are citing in when they're looking at some of the M&A transactions that we've seen sort of rampant throughout the offshore space, acquiring these assets. Now, we have to be careful about definitions here. Traditional finance theory defines an asset as a resource that can create economic value. And so a simple way to think about that would be the ability to provide a positive stream of cash flows somewhere into the future. Now, we know that platforms certainly can fit this bill, but they do also have fixed operating costs associated with them and a pending decommissioning liability on the back end. And so there's certain situations that exist where those negative cash flows overwhelm the positive ones, and they start to look a lot less like assets and more like liabilities, not unlike a regular bond. And so here's the pivotal question. How do you tell the difference between the two outcomes? This is important to an investor who's perhaps thinking about funding one of these acquisition ventures. And so at RSEG, we spend a lot of time looking at different assets in the offshore space. And we spend our time specifically focused on decades of production data so we can train our models to be able to predict outperformers out of a subset of large platforms. And we use these models to rank platforms on a spectrum, and that helps clients differentiate between the assets and the liabilities of the group.